Hi there, everybody. So let's kick off. Now, the number 2 stock trader on the whole Etoro site by copiers and probably by assets under management is a guy called Jeppe Kirk Bonde. Apologies if I mispronounced that, I almost certainly did. Now, if you wanted an analysis of Jeppe, then you can go across the Felix Falix or social trading vlog. I'm going to be doing this from a financial point of view. And the kind of questions I'm going to be asking are, what's the quality of his portfolio like? What's the value of his portfolio like? What is the momentum of his portfolio like? And I'm going to compare him to other top 10 traders, let's get that out, on Etoro. So looking at his portfolio, his number 1 position at 4.5% is a company called Swedish Orphan Biovitrum. He's then got a similar holding in Amazon, Nintendo, a big holding in Lidos, and these other bioscience companies like NBix, FB, Facebooks, Afria, NetEase, China Everbright, Google, and so on. So what we're going to do is take Swedish Orphan, SOBI, and we're going to plug it in to Stockopedia. Now, Stockopedia, as you know, is one of the sites which give an incredible amount of information from a financial perspective, and it really is a wonderful place to find out about financial information. Now, this will look a bit overwhelming in terms of the amount of numbers that you have here. It just goes on and on. This is just a small portion of it. But they've made it really easy for you, for everybody. In the top right-hand corner, you see here quality, which means I've already discussed this in the past in terms of return on capital employed. Here we go. It's 12.3%, which is good. Compare it to the industry and also the marketplace. Return on equity, another quality financial metric, and operating margin, which is actually fantastic. It's just another 30%. So 73 is a good quality indicator. It shows that this company has good financial metrics. In terms of value, we use different financial metrics, especially PE ratio. I've explained what that is before, but in a very simple term, what that means is how expensive the company is. Price earnings ratio. PEG ratio is, I think, an even better ratio to understand how expensive it is. That's price earnings growth ratio, which puts into play estimated earnings for the next 12 months. And if it's below 1, it means it's good value. So you can see this company actually is very good value. EPS growth, earnings per share growth, it's been growing at more than 21%, doesn't pay a dividend. And if we look at the profitability, it's actually net profit. You can see it's been going up steadily. It's been plateauing off in the last couple of years, and it's going to take a small hit next year. Well, you know, this 2020 estimates, and next year, 2021, it's going back to its trailing 12-month basis, which means the last 12 months, as opposed to just the last set of annual accounts. Now, in terms of momentum, it's very poor at 14. Now, what does that mean? It means that if you look at something like the relative strength, which shows how it's performing against the rest of the market, this last month it's been getting better, but if you look at the last 3 months, 6 months, it's poor. So not so many people are buying into this share. Volume recently is going up in the last, you take the last 10 days versus the last 3 months percentage. So you can see that it's been going up. Again, that's shown in the recent moving average as well. So what moving average means is you take, in this case, the last 50 days, and in this case, the last 200 days of average share price, compare it to the share price it is today, and you can see that it's moving upwards. The trend is moving upwards, although if you look at longer term, it's moving downwards. So what does that mean? It means that this is actually not a bad company. Now, just going down to exactly what they do. So Swedish Orphan Biovitrum is a Swedish-based pharmaceutical company. The company develops, manufactures, and sells medications within hemophilia, autoimmune diseases, metabolic diseases, and cancer supportive care. And it's got 3 business segments, and it goes on and into different aspects of the company and what it does. I think this is actually a very decent company, and we don't see this kind of a company so much in the top traders' portfolios. That's actually very good. Okay, so let's go into the next one. Amazon. Right, I'm not going to spend too much time on Amazon. I'll just show you the very quick snapshot of the quality, value, and so on. What's the ticker symbol is AMZN. Here we go, New York Stock Exchange, NSQ. So Amazon is 91 in terms of the quality. If you look at the ratios that we use, return on capital is okay. It's not fantastic. But if you compare it, I mean, there are other companies, when I say it's not fantastic, compared to other companies, software companies, tech companies, they have much better return on capital. However, for a retailer in the industry and market, it's very good. Generally, retailers and capital-intensive companies, car manufacturers, anything that's manufactured, have lower return on capital because of the intense nature of their capital requirements. They've got to build lots of stuff, and in Amazon's case, they have to build lots of distribution centers, have lots of vans, aeroplanes as well. They have so you would expect the return on capital not to be so great, but when you compare it to the industry market, it's good. The other metric is operating margin. For retailers, it's very good. Most of them are at 2%, 3%, 4%. Amazon is is about to hit 6%. So in terms of quality, it's a very good quality company, 91 out of 100. In terms of value, it shows that because it's in red, it's overpriced. PE ratio 70, that's very high, which tells me that the financials are saying that this is an overpriced company. The PEG ratio, anything over 1, is poor value. EPS growth just means that the share price is growing really fast. It doesn't pay a dividend, although when you look at the profits, now look at this. If you look at the revenue, it's been shooting up 379 billion, nearly $380 billion of revenue, and profits, net profit, which means after all costs, actually the vast majority of costs, net profit is just under $18 billion. Now, in my opinion, and look at that, next year, they're expected to do 23.5 billion profits. That's massive. I can't imagine how much money that is. So it's incredibly profitable. And you can see over the last few years how the profits have just been ramping up from 3 billion to 10 billion to 11 to 17 to 23.5 estimated. Why are they not giving a dividend? They should be distributing some of that money back to shareholders. And I think then Amazon will become an even better prospect company to invest in. So, okay, so Jeppe's got Amazon. Let's go to Nintendo. Why I keep on saying Nintendo. Nintendo, I think it's because of the ticker symbol. NTDO. NT. Let's just type in Nintendo. There we go. It's coming up with a different ticker symbol, 7974. Okay, so in terms of quality, right, of course, you know everybody knows what they do. They are engaged in development, manufacture, and sale of entertainment products. It's a gaming company, but I think they do an awful lot more than that. Massive company based in Japan. So let's look at the quality. The financial ratios say, and it's getting better as well, financial ratios say 93 out of 100. So return on capital, 32%. Now compare that with Amazon. Very, very different businesses, of course, but the return on capital for Nintendo is much better than Amazon. Return on equity, 26%, operating margin, nearly 34%. That is fantastic. 34% of their, operating margin, which means the first level of profit. So remember, operating margin means the income of a product or service minus the direct costs of producing that product or service. So 34% is fantastic. This is a really good quality company, and of course you can tell from the metrics. Now value is 38. It's been going down, which means that the share price, yes, you can see share price has been climbing upwards, but still 38 is a very good value company, a very good company compared to if we looked at Amazon, if we looked at some of the other bigger companies. I mean, look at Tesla, for example, their value is really, really poor because the share price has gone up so much. Now, dividend yield, fantastic, 2.3%, nearly 2.4. Anybody would be happy with that. So a company price that's going up, good value, good quality, and look at the momentum, 99. Which shows that it really is getting, there's a lot of growth prospects, and people are pricing in higher share levels to this stock because they think it's got a very bright future, especially short term. If you look, for example, it's not too far off its all-time high in the last, 52-week high. And if we look at the last 3 months, it's been a bit choppy going up and down, which means it's a little bit volatile. And it went all the way down to 51,680. Now it's 63,000. That would have been the time to buy, I think, recently. And look at that, stock rank was at 95 at the time. It's been climbing. But I still think this is a good time to get into this stock. I might pick it up, actually. Okay, so that's the next one. Now, Lidos Holdings, LDOS. Let's have a look at that. That's one I'm not that familiar with. What do we see? We see quality at 69, value at 57, momentum at 63. Let's see what they do, first of all. So Lidos Holdings is a global science and technology company. The company provides technology and engineering services and solutions in the defense, intelligence, civil, and health markets. What does that mean? National security solutions. It looks like it's a software company. Health and infrastructure with lots of government contracts. Providing information technology management and engineering to civil defense and intelligence agencies of the US government. Yeah, here we go. So you'd imagine their earnings would be very stable and they've got big contracts. Look at the revenues. How's it gone up? It hasn't gone up very much, actually. In the last 2, 3, 4 years, you have to go back to 2017, 18 to see a big growth, but it's plateaued off, especially here. Look, 2018, 2019, 2020. That's one question mark I'd have over it. How have the profits done? Net profits have 2018 jumped to quite a good level. In 2019, gone up again, taken a hit in the last 12 months. And trailing 12 months means the last 12 months of available information. So each company, especially in America, has to release quarterly earnings. So the analysts take the last quarter, last 4 quarters, as opposed to the annual reports, which may well be out of date. And obviously, every company has to give earnings calls, and they give estimates as well. So that's where all these numbers are coming from. So what does that show? Return on capital is 10.8. It's okay. It's good by industry standards. Return on equity 17.7%. Operating margin is only 8%. Now, when you compare it with the other companies, I think there's better quality companies out there. And that's reflected in the stock rank, 69 out of 100. It's good value at 57. Momentum is at 63. I won't go into all of the different financial ratios. PE ratio is 16. Remember, Amazon was 70. And here we see it's quite a way off its 52-week high. It hasn't really recovered. So it's 120 before, well, in February, before everything crashed. And it went down to 75. It's recovered to 104, but it hasn't recovered to its pre-pandemic levels. That's 123. I wonder what's holding it back. Let's have a look at the news. What's been going on recently? FAA, they've got some really good clients, the US government. And they've been making acquisitions as well. So it looks like a decent company, but it's being held back by the quality. All right, so let's have a look at the next one, NBIX. Now, Jeppe's got a big holding in this. These are his top holdings. So it's a bioscience company. Let's have a look at a bit more detail in terms of what they do. So Neurocrine Biosciences is engaged in discovering and developing pharmaceuticals in diseases with unmet medical needs through its research and development platform focused on neurological and endocrine-based diseases and disorders. Okay, so it's a biotech company based in San Diego, lovely part of the world. Now let's have a look. Quality 67, value 23, momentum 11. It's an unloved stock with decent quality, market cap of 6.5 billion. Now let's look at the financials in a bit more detail. Revenue has been going up and profit has been making an operating profit, and now it's making a net profit as well. It's a profitable company now, not hugely profitable. You can see with the operating margin at 13. Oh, that's 13% is actually very good. Yeah, 13%. I mean, this the last annual accounts in 2019, the operating margin was a lot lower. But they've clearly become profitable, and they're expecting to triple their profits between 20 and 21. That's really good. And if you look at return on capital employed, one of the metrics I love, from negative to positive, and you'd expect that when a company starts making money. This is a decent company. One concern I have is about the momentum. People aren't picking this up. They've called it a falling star. Now, why? What's been going on with the share price the last 6 months? Oh, wow, look at that. From 135 to its present of 95. It's really been going down. I mean, it's spiked up here and here a little bit, but the share price is really struggling. This is one for the long term. I think this is a decent company, but it's undervalued, maybe underlooked. Okay, let's look at Facebook. Facebook, right, I'm not going to tell you what they do, what they are, you know that, and where they're based, which is Menlo Park. It's Silicon Valley, massive operation. Now, quality, look at that, 99 out of 100. Now, how do we measure that? Return on capital, 21%, operating margin, 36%. That's a bit like Nintendo. The operating margin, fantastic. In terms of revenues, you can see it's been going up and up and up. It's going to be hitting 100 billion, over $104 billion. And its profit will be over 30 billion. They must have a huge stockpile of cash. This year's estimates is 27, and the 12-month trade 25, 18, 22. So look at this. In 17 to 18, they jumped from 16 billion to 22 billion. Then they took a hit in their profits to 18 billion. Now they've jumped back up to 25, and it's just going to grow and grow and grow. This company's got a bright future. In terms of value, 28 at the moment. And momentum 84, very good. I'm not going to go into too much detail with Facebook. Let's go on to the next one. Afria, APAH. Not a company I'm familiar with, but look at that. Quality is very, very poor. Who are they? Canada-based cannabis company. The company's Canadian cannabis operations are comprised of its Afria 1 greenhouse facility, held through its wholly owned British Columbia-based subsidiary Broken Coast Cannabis Limited. So this is taking a gamble on the legalization of cannabis. Many of the US states have done that. But here are my concerns. The quality of the company is very, very poor. Return on capital is minus 1.8%, which means it's, yeah, you can tell here, it's losing money. But if you look at the revenues, this is all in Canadian dollars, 37 million, jumped to 237, jumped to 543, and its earnings estimates is that it's growing really, really fast. So Jeppe's taking a big bet here on cannabis, and a lot of his companies are in the healthcare industry. Net profit. Now, when you've got minus, and when you've got losses here, this one is 106 million loss, and they're going to cut it, they say, in their estimates, and next year they're hoping to be profitable. They were profitable before, you can see here, but that might not be because of what they're producing. It simply might be for other reasons. I'd have to look into a bit more detail to discover that. But one interesting thing here is, look, they've got quite a bit of cash. What is it, Lot? 400 million? It's not for you and me. But in terms of how much they're losing 106. Now, if they really are going to become profitable, then that's a decent cash pile. They can use that to fund acquisitions. In fact, let's look at their news. What have they been up to recently? So, yeah, look at that. So Bloomberg says that Afria are combining their operations with Tilray to become the all-stock deal will create a new company with an equity value of 4.8 billion. So what is it at the moment? It's 1.71 billion pounds. So that's going to double. They're merging with someone else. They're actually taking over because they're paying the 23% premium to Tilray. Now let's just go into Tilray for one moment. Let's see if they are listed. They're listed. So Afria are buying this other company, but look, the quality level is 1, momentum is 4. I think they're going to be overpaying for this company, which, yeah, look, it's all red. This is risky because this company could eat up all of Afria's cash. Look at that, 276 million loss, 488, 321, and it's not going to become profitable for quite some time. So when you go back to Afria, I think, oh, what happened there? Is Afria APHA? APHA. Here we go. Sorry about that. I have concerns about this company. I think this is very risky from a financial perspective. Quality is very poor. They've just done a merger, and I personally wouldn't want to see a stock in my. Well, I suppose you can have one wild card, but you know you've got to know what you're doing. Right, let's go on to the next company, NetEase. Now, NTES. Here we go. Listed on the stock exchange in New York. Now, who are they? The company is a technology company, operates 3 business segments: online gaming, especially on mobile and PCs, including Westward Journey, on Myoji series. The Yaodao segment provides intelligent learning services. Its products and services include Yaodao Premium Courses, Dictionary Pen. Innovative business and other segments provide products, NetEase Cloud Music, Mail, and News. Based in China, Hangzhou. Quality-wise, 98, fantastic. That's really good. Return on capital, 14%. Operating margin, 22%. Really, really good. Value is okay at 32 out of 100. Let's look at some of these ratios. P ratio is nearly 100. Ouch. I think that's overpriced. And it's paying a dividend, which is good. So looking at the financials, 61. Oh, these are renminbi, the Chinese currency. And I mispronounce it every time, sorry. Net profit 16.2 billion, and it's growing to 19.2 estimated next year. But that's still lower than its 2019 level, much higher than 2018. So you think, what did they do between these 2 years to make their profits jump by more than 3 times? Mind you, their profits had gone down from 2017 to 2018. Momentum is 52, which is okay, nothing special. But it's a good quality company. I'd be happy to hold that. China Everbright, let's look at that. That's the next one. I saw it there. There we go. I think China Everbright. China Everbright. Now, who are they? Investment holding company, mainly to do with financial services, operates in 2 segments: fund management and principal investment businesses include strategic industry investments, financial investments, platform investments, including aircraft leasing, artificial intelligence of things, elderly care industry platforms. I'm having trouble getting my head around all these things they do. It's an investment. Is it an investment bank? No, it's an investment financial services company. They've got holding stake in China Everbright Bank. Okay, all right, that's a better idea. And they're based in China. Everbright is a nice name. Quality is poor at 45. Value is okay. Momentum is poor. Now, let's look at some of the return on capital, 3.6%. So what they've done is taken a lot of money, invested it into lots of different places, and hoping that in the future, they bring good returns. Operating margin 72%, which is huge. Now that is because they don't have much overhead. Clearly, with a service that you provide, it's not the same as building factories and something which is very capital intensive. That is a very good thing. Revenues have been shooting up. Very profitable company, which is good. Although, having said that, Look at this. Now, this I've never seen before. This is in Hong Kong dollars. So here you see 2015, 2.1 billion Hong Kong dollars in terms of revenue, but the profit is 5.1 billion. How does that work? They did the same thing in 2014, where they had more profit than they did with revenue. Now, what that means is that they've sold off some of their investments, which sits on the balance sheet, and they've realized the gains. And that doesn't come in revenue, that comes in below the operating profit figure as a one-off. So that's why that happens. And again, I mean, there's a habit of that. 2.1 billion here and 4 billion in profit. But having said that, their profitability has been going down considerably, which means that they're not selling off so much in terms of their investments. Now, that would mean that explains a lot why the quality is only 45. It's an interesting company. Right, let's do one or two more. Let's do Google. Also Alphabet. Now, I'm not going to go into too much detail, but here we go. Quality is 86, return on capital 13.9%, operating margin 20%. Compare that with Facebook, and it's not as good. Compare it with Amazon, it's much better. But when you compare it to the industry it's in, what industry is Google in? It's got its fingers in many pies, isn't it? From self-driving cars to healthcare to obviously the advertising platform. Value is decent at 30, good momentum. P ratio is not too bad, 29. And dividend yield, no dividend. Now let's have a look. Revenues have gone, look at that, $66 billion to 75 to 90 to 111 to 137, 100. It's just been growing and growing and growing. And look at that next year. It's expecting to go from just under 179 billion to 217 billion. So compounded annual growth revenue is 20%. That's fantastic, especially when you're that big. It is brilliant. It's a money-making machine. And if you look at the profit, net profit, 14 billion, 16, 19, takes a dip here. Interesting to know why. Maybe they made some big acquisitions that dragged on their profitability. Here, 2018, 30 billion, 34 billion, 35, and it's just going on and bigger and bigger. So you can see the compounded annual growth is roughly, in terms of profit, roughly the same as the revenue. So that means for every pound they bring in or dollar they bring in for revenue, it's the same amount of profit is being made at the same rate. Sometimes companies grow and get more revenue, but their profit doesn't necessarily stay at that same rate. In terms of Google, it does, which means it's really good. Now, if I was making 40 billion here, look at that, 42 billion in profit, I'd want a dividend. You can see, look, they're sitting on $132 billion worth of cash here alone. What are they going to do with all that cash? I think they should give it back to shareholders. They can easily afford a 1% dividend, as can Amazon and Facebook. I think these tech companies really do need to start giving back to their shareholders, not just in the appreciation of the stock, but also in the cash. Okay, look, I'm not going to go through all of his stocks. That will take far too long. But what I've done here is taken the top 14 and plugged in all of the numbers. I did that a couple of days ago, so I'm hoping the numbers are still the same. Now, his top 14 holdings account for more than 50% of his entire portfolio. And the first question is it a good portfolio in terms of quality? It's got 69. Now, compare that with what we did with Jay. Jay was at 67. So Jeppe has got a better quality portfolio marginally. But here's the big difference. Jay has got 21 in terms of value. Jeppe's got 49. Now, why is that? Because Jay's got a lot of US stocks, which are very overpriced. Look at that, Fiverr at 2 and Shopify at 1. Whereas Jeppe has got a much more balanced portfolio and better quality. Look at that. Sobi, the Swedish orphan biotech company, 66. We've got here one company we didn't cover, but it's 89, which is really good value. Quality is not so great. But in terms of value, and here, 92. That's the financial services company in China, I think Everbright, that we came across. Let's just double check that. Everbright. China Everbright. No, maybe. $45.63. Has it changed so much? Let me just change that. 45.63 and 30. How does that change the numbers? So I've had another look at this. Now, the company I should have looked at is 257 on Stockopedia, which I put in here. So let's do this one instead. It's China Everbright Environment, very similar to the other China Everbright. Now, what this company does is it's an investment holding company engaged in the energy and infrastructure related businesses. And you can see this in a number of top traders, that they've got energy type companies. This is financing and investing in energy companies based in China. Now, its quality is very poor. And if you look at the return on capital, it's actually not bad, 10%, and the operating margin is 26. There are other quality indicators which suggest that it's not that great. Can we figure them out? Let's have a look at the financial accounts. Well, but looking at it very quickly, operating cash flow is very poor. It's negative, although the profit is positive, very healthy profit. So the question is, how do you have very healthy profit but negative cash flow? The question is a very good one. So that's between accounting and cash. Accounting simply means you've got things like depreciation, you've got other things which you can not put in the accounts straight away. They can be on the balance sheet. Whereas when you're dealing with cash, it means that you have to pay for everything up front. And that's an outflow of the business. Now, in spite of it having negative cash flow, let's look at how much cash it's holding in the bank. Over 10 billion Hong Kong dollars. And it's always had a lot of cash. Look at that. 5 billion, 6 billion, 6.3, 9.5, 14, 11. It's a very, so they've been raising a lot of money. And you can tell that from the net debt. Again, something that will bring the quality indication down. It's got 51.8 billion Hong Kong dollars in debt. You would expect an investment company to carry some debt. And you can see, look, the P ratio is very, very low, 3.9, which makes the value very good. But this is really long term. When some companies like this invest, they invest for the long term. It's very capital intensive looking at energy. You've got all sorts of infrastructure which you have to put up. It takes years and years and years, maybe 20, 30 years before you get your money back. So although it's very good value, this is something you would only make money off if you held it for the long term. And look at the share price in the last year. It's gone from, what is this? 6.25 to 4.44 at the moment. It went down, as did everything else, This went down to 3.77. So it's recovered quite a lot, but not a huge amount. It hasn't gone back to pre-pandemic levels. Look at that. Share price is over 6, and that's in January. It was going down before the pandemic quite significantly. Now, let's have a look at any news it's got. I expect it to be very political because the Chinese government will have the last say on this. And I expect them to be pumping in lots of money. Looking at the balance sheet, I'm not going to take you through this, but basically it's got cash, but a lot of debt. We've seen that already. Current assets here at 30 billion. Net goodwill, tangible assets, it's only got 18.4 billion. And long-term loans are actually 61 billion. This is a highly indebted company. I would stay clear of it myself. Okay, so let's go back to comparing the two portfolios, Jay's and Jeppe's. Jeppe. Now, when I put in all of the different numbers into quality, value, and momentum for Jeppe, 69 in terms of quality, it's marginally better than Jay's. Much better value, but lower momentum. Now, let's look at sector diversification. He's got biotech companies, he's got US tech companies in Amazon and Facebook and Google. He's got Japanese gaming companies, so he's got international diversification. Energy, biotech, he's got a bank in there as well. So I think his diversification and international exposure is actually very, very good, much better than Jay's. And I'd say non-US tech versus the rest, yes, he's got a lot of different companies in there. He's got a fund for India as well that he's investing in. It's his 15th largest holding. Cash holding, let's look. I like to see between 5 and 10% cash holding. So if you stroll all the way down to the bottom here, 0.6%, nothing. He's not holding any cash. So when an opportunity arises, then he's not able to take advantage of it unless he sells something or brings in cash from outside. I like to see people holding 5 to 10% minimum cash. And in the current environment, I'd say slightly more. The ideal number of companies, we've discussed this in the past, research and statistical analysis shows 15 to 25. Jeppe has got 49, similar to Jay. I think Jay had 50. I think that's far too many. And I've explained in previous videos why that is. Let's see what's driving his profitability. So look, this is one reason why you shouldn't have so many holdings. He's got fantastic results in Palantir. That's a security company, controversial ones, Peter Thiel's baby. 190% nearly, but he's only got 0.5% of his holdings in it. So even if it goes up to 1,000%, if with such low holding, it's going to be a marginal increase in his overall portfolio. Now, if he had taken greater conviction on that, and also in Tesla, look at that. Tesla's gone up by more than 120% in his portfolio, and Xiaomi, pronounce that wrong, I know, and Bitcoin. So what you want is your biggest profits to be with your largest holdings. Here, that's not the case, and that's one weakness in his portfolio. He doesn't have the conviction of allowing his biggest profitable trades, I mean, he's identified these companies after all, to have enough of a holding. So although all of these stocks have done really, really well, they're not going to add very much to his portfolio because he's got such a small percentage in his portfolio. I mean, this one is not bad, Afria. He's got 3.6% holding, which is, if you add it up, more than all of these added together. So Afria's added more in spite of the greater returns of these other companies because he's got a greater holding in it. I hope that makes sense. And you have to go all the way down to Nintendo before you see another large holding getting profits. So let's look at his losses. And this is what you don't want to see. So you don't want to see a big holding getting worse profits. Maybe either buy more or sell it. That's what I would do. Silver, minus 15%, but it's only 1%. But here, look, this bioscience company is a big holding and it's making a loss, which tells me that that's why this is only 33%. Jay had 89% and 33% versus even his performance last year. So these are the reasons why he's being held back. So when you look at the overall strength of his portfolio, it's got a good value, decent profit, decent low momentum compared to others like Jay. His profitability is 32% overall. Jay's got 89. But I think next year, I think this portfolio will probably do better than Jay's because Jay's got too many companies which are far too overvalued. So that is my thought on Jeppe's portfolio. Thank you, everybody, for giving me the time. Take care.